best companies to invest in. In his book Unusual Billionaires, author and maverick market analyst Saurabh Mukherjee has sieved through 1,500 companies to find those that have given 10% revenue growth and 15% return on capital every year for the past 10 years. He has found 7 such gems. The 2 banks in that list of 7 are HDFC Bank and Axis Bank. HDFC Bank has the distinction of giving such returns for not just 10 but 20 years. Born into a world dominated by large public sector banks which lent to large corporates, HDFC Bank discovered and taught the banking sector the importance of CASA, or current and savings account. It also taught the world the open secret of good execution. Axis Bank, on the other hand, has managed an even bigger feat of giving consistent returns over 3 changing leadership periods: the pre-Nayak period, the PJ Nayak period, and the Shikha Sharma period. That's a rarity. Joining me is, of course, the author of the book, Saurabh Mukherjee, but the representative of HDFC Bank since its inception, Mr. Paresh Sukthankar. Mr. Sukthankar, adjectives have come your way, I'm sure, but today we want the analysis. You know, in 1994, when you all got the license, you all started as a corporate bank because at that time the word retail was not known. How did you become that retail bank? How did you think of it? How did you execute it?
Sure. So first of all, I think it was logical for us to kick off our business as a corporate bank. A couple of reasons. One, there was clearly this gap from a corporate treasurer's point of view where they were dealing with public sector banks and foreign banks. Clearly, the public sector banks had the local currency funding capability, while the foreign banks had the product range, the technology, the service. And we positioned ourselves right there in the middle, combining the strengths of an Indian public sector bank and a foreign bank. So it was really, a best of both. Having done that, you did realize, of course, that corporate customers will give you lower interest rates, and the yields are lower. And therefore, the only way you can be profitable is to reduce your cost of funds. And the volatility that you see in being dependent on the markets for funding is clearly not a happy place to be. So it was logical for us then to transition from being a corporate bank, of course on the lending side, to building a retail franchise which would give us a stable and hopefully a lower cost deposit base. So that was clearly our first entry into retail was on the back of the deposit franchise. Before, of course, we also went into retail lending. Okay.
Now, Saurabh, in your experience, what made them click? That without having as many branches as even the smaller PSU banks would have, how did they manage the retail piece?
So I think what's very interesting about HDFC Bank is so much of what they do now, we take as granted in our day-to-day lives. So for example, I work in a stockbroking firm. We obviously help our clients trade on the NSE and the BSE. We're helping clients clear trades. We use HDFC Bank, so do all our competitors, right? So the entire stock market uses HDFC Bank, and what people like me who've only entered the trade in the last decade or so don't realize is in the late 90s when HDFC Bank went to the NSE and the BSE and said, we will help you run a seamless clearing and settlement process with online visibility to how much money needs to be cleared by each broker. That was a complete first in our country. No other bank had done that. Similarly, the fact that we get our salaries deposited directly into our accounts across the country, HDFC Bank came up with the concept. What this bank was able to do very successfully in the late 90s was use the then available technology and apply it in a certain way which allowed corporates to bank across the country, especially corporates who were dispersed across the country, to bank across the country with one bank and electronically transfer cash in a way that simply wasn't possible until HDFC Bank made that innovation possible. That established the fundamentals of Indian retail banking as we know it today, and I don't think it's something that a lot of people realize, and I don't think they credit HDFC Bank with that degree of innovation.
Okay. So there are 2 things that HDFC Bank appears to have contributed to the banking lexicon: core banking and CASA, making it so important to have low-cost deposits. But Mr. Sukthankar, there are 2-3 words that stand out in the description of your bank. Saurabh titles his book, his chapter, HDFC Bank, The Power of Textbook Execution. And the seminal sentence he says is, as simple as it sounds, execution has made HDFC Bank stand apart from other banks. How do you explain this? How is it that you all stood out on execution?
Well, I think, we first of all recognize that the market opportunity is genuinely large. Okay, so we believe that, India is an underpenetrated market. And when you have that size and the economy is growing and that creates banking opportunities, if you accept that, then it's really left to you to define what segments you really want to serve, and then we become an execution story. Anybody who has, a reasonable strategy in place, has a product range, obviously you need the brand, the distribution, the technology, the people, and then that really boils down to execution. Frankly, if you look at the strategies of different banks, everybody talks about focusing on a few things, right? Low cost of deposits, a certain asset franchise, fees, low NPLs. I mean, I think the commercial banking is not a very complex business in terms of the strategy or the, what you should be doing. And therefore, the gap between what you think you should be doing and what you actually do is execution. And frankly, I think, in many ways, the ultimate compliment you can give to a bank is that you're executing these little small things right? It's the detail is really what really makes a difference, especially in retail and perhaps true in wholesale as well. And maybe in some ways, I think the other piece which people tend to talk about us, which is being a little boring, helps in the fact that, we are a little more consistent, and execution is therefore certainly a forte for us.
Well, it's not impossible that people could make mistakes even in retail. For instance, you all do a significant amount of credit card loans, and that is high return but also high risk.
True.
How is it that you all didn't mess that up?
So I think, what we've done is across the entire range of retail products, from credit cards to, well, actually home loans with HDFC, but pretty much the full range. We've been very conscious of the fact that when you're running a retail product, it has to be run where the portfolio is ultimately reasonably consistent. So we, define a set of policies, or what we call a product program, centrally. And then essentially when you're doing the credit buying across the entire branch network or other channels of sourcing, you're sure that what you're generating ultimately is a consistent portfolio. It's not each branch manager or each credit buyer taking a call based on what he thinks or she thinks is a good or bad loan. In the credit card business, because it's unsecured and then, it's certainly a higher risk, we focused a lot more on our internal customers. We defined the segments that we believed made sense for us, and we, in almost every business, and true of cards as well, we, it's not that we don't explore new segments, but we would pilot them and then expand gradually. So, and there is there's an element of expected loss in every product. So if it's a higher risk and there is a higher yield, you're essentially factoring in, or you're pricing in that higher risk. It's not to say that across various retail products we have not had some credit cycles and so on. It's just that by not going overboard in terms of making those calls, we could tweak our portfolios, make corrections where necessary, and essentially ensure that the actual losses that we incurred were what were within the levels that were priced in. And in many ways, if we are a market leader in many of these products, it certainly gives you the leeway of being able to invest and stay ahead, both from a service and product feature perspective and a risk management perspective.
Well, Saurabh, the other bank you have in your book is Axis Bank. Now, whether you compare HDFC Bank to just another bank or to the other companies that you have, HDFC has not gone through a change in leadership.
Yeah.
Would you think that's a challenge? Axis has gone through 3 times, and other, the Maricos and all have also seen more CEOs come by. You think that somebody who buys the stock now with an expectation that the previous 20 years will be repeated over the next 20 years, can believe that the process will continue?
So on the cover of the book, there's this image which I think you guys have also shown it on the screen. There's lots of men in suits with their umbrellas up, and then there's this one businessman who's keeping his red umbrella down. When I was interviewing Paresh for the chapter, and when I was looking at HDFC Banks' numbers over the last 15, 20 years, that image came to my mind repeatedly. What HDFC Bank has repeatedly shown is when others exit a loan category. For example, post-2008, other banks, due to balance sheet stress, exited car loans and credit card loans. HDFC Bank chose that moment, post-2008, post-2009, to build what is, I think, one of the largest car loan portfolios today. That counter-cultural, sort of counter-cyclical risk cycle, that you time your entry at a point when others might not think this is the right time to enter, I think that culture is ingrained in HDFC Bank. We could discuss contemporary examples, but perhaps best to do that off camera. Even today, I think they're doing a few things which I think goes against the grain of current perception of, say, lending on corporate risk. That counter consensus call on risk, I think, is ingrained in this bank's culture. I think that will hold them in great stead for a long period of time. The specifics of execution might or might not change over the coming decade, but I think that culture that you might want to take opportunities when others are looking away, the sort of the image that I've tried to illustrate through that man with the umbrella down, I think that's not going to go away from this bank for a long, long time.
Okay. That's a great lesson to learn from HDFC Bank. The fact that they do the simplest but the most difficult thing very well, execution, and the fact that they are constantly innovating, looking at what the customer wants, and as Saurabh correctly put it, being alert to where the risk is, where the industry is shying away from, and where therefore an opportunity rises. Looks like this will be a perennially young bank in its thinking. Thank you very much for joining us. We are going to be back in a minute with one more gem that Saurabh has picked up. Now we discuss Axis Bank, and to discuss what went so right with Axis Bank, I have with me the Deputy Managing Director of the bank, Varadajan Srinivasan, and of course Saurabh Mukherjee, the author of the book. Well, first to you, Saurabh, what stood out for you to pick Axis Bank besides the numbers itself? We know, of course, that they did 15% loan growth and 15% return on equity in the period that you are studying.
Axis Bank, as you know, Latha, has had a more sort of tempestuous history. Three different managing directors, three very different avatars, the pre-PJ Nayak era, the PJ Nayak era itself, and then the Shikha Sharma era. Three very different eras, and yet what's very striking about the bank is reasonably solid performance, especially in the last 15, 16 years. At a time when the Indian economy transformed, to deliver under a man like PJ Nayak, who was a erstwhile civil servant, became a superstar banker, intense period of growth through the noughties, and then a slightly turbulent transition, but pretty solid 2 to 3 years under Shikha Sharma until the economic downturn hit Axis's loan book. So very interesting bank to write about, perhaps the hardest of the 7 chapters, the 7 companies, perhaps the hardest to write about, because a very changing themes and changing styles of management made it probably the most interesting chapter in the book to write.
Oh, absolutely. Well, actually, let me start with the tumult itself then, Srini. When PJ Nayak left, and as Saurabh says, when Shikha Sharma took over, it was not an easy transition. There was resistance because there was a whole lobby which wanted internal candidates to be the MD and CEO. What do you remember of that transition? How come it was ultimately a very smooth one?
Well, I think, as Saurabh said, Axis during the Dr. Nayak era had an extremely strong performance. I think it was growing at a scorching pace compared to the rest of the system. When the change happened, of course, as with a lot more turbulence than one would have expected, I think nothing changed as far as the script was concerned. I think the bank already had a great franchise going. It was basically now trying to see how to make it sustainable and how to make it scalable, and I think that was the focus. And how do you change the business model at the margin to try and make sure that the franchise, which was extremely good, goes on to greater heights. And I think that was the focus. Once Shikha came in, I think the idea was to get everyone aligned. Everyone aligned in terms of we are in a great place. Now, how do we take this forward and get everyone aligned to how exactly we're moving forward? So whether it's technology, whether it is data, whether it is changing the loan book mix, I think it was a discussion which happened across the senior management. Everyone got aligned, and when everyone understood this is a path which looks the right way to go, I don't think so. People generally then believe in the story. And once you start believing in the story which is going to unfold, I don't think so. You have the issues which you talked about.
Okay. But actually, tumult didn't stop, Saurabh, only with the PJ Naik, Shikha Sharma transition. There was a bit of a tumult, at least in the markets and between the regulator when the NAM acquisition happened, if you please. How did that seminally change anything in the bank at all?
Not really. I think I wouldn't agree when you say there was tumult at the time.
It's a strong word, but there was
I don't think
a toing and froing between you and the regulator.
I don't think so. I don't think so. I don't think so. There was any regulatory issue as far as the transaction was concerned. The Enam acquisition was clearly trying to fill in a gap which otherwise Axis had. If you look at Axis, I think clearly we were the largest player on the fixed income side, whether it was loans in terms of actually being on the corporate side lending as well as syndication, and debt capital markets a franchise which I think we have an unrivaled position for the last almost 10-15 years. But on the equity side, it was something which promoters clearly have a lot of mind share, and for you to get timeshare with the promoter, it is important for you to be present on the equity side. And that's a franchise which I think Shikha and me clearly have tried creating organically in various avatars before. And we always knew that getting the mixture right in terms of people and track record is extremely important. And unless people work together strongly, it's not going to get done. So I think we looked at the inorganic route, and this was something which was a franchise which has been in existence, top of the heap for the last 20 years. And look like this is a gap which we have in the franchise, and we needed to fix that gap, not just from the investment banking revenue as such. I think when you get a promoter's mind share, when you do a good equity transaction, which is probably even just 500 crores, and raise equity for a good price, he's extremely happy. You can get a lot of annuity business, which otherwise you'll struggle, whether it is your salary account, whether it is cash management. Some of these things the promoter doesn't even look at. But when you do an equity transaction and ask him this, a lot of these fall in line, and that may not necessarily.
That also boosted. I mean, you already had a very strong liability franchise, but this addition has.
In our view, it complemented our commercial banking franchise. Meaning, if we didn't look at it just as a plain investment banking activity.
So both asset and liability side it has brought.
It is huge synergies. I think we can talk of multiple transactions which you've done, where not one piece of the business has gone to anyone else from when we got in early on the equity side.
Okay. Well, the other point I wanted to ask you is exactly this two-piece where you have your feet. You have a decent retail portfolio, but you are still, at least up until 2 years back, more a corporate-facing bank. Now you of course tried to bridge, and I guess you're 40-45% into retail. Can that corporate piece still take away some of your luster? Is it still, or are you definitely behind the hump, or the hump is behind you in terms of NPAs?
I think my view especially is that everything is a cyclical business, whichever segment you are. I think clearly the cycle can go along with the economy, can go along with the events, but ultimately everything is a cyclical business. For you to have a sustainable franchise, you need to have a business mix right, and you need to be able to push different levers at different points of time to make sure that you have a sustainable franchise. And I think that's where we've reached right now. I think if you look at the composition of our balance sheet, whether it's a loan book or otherwise, I think we have a mix which clearly is very balanced, and our strengths across segments are extremely strong. So I think we will take it as it comes. Retail still continues to be the fastest growing segment for the system, and we have our strengths in retail. So that would still be the driver for growth in this year and possibly the next year. But if things change and there are opportunities which come to on the corporate side, I think we have a very strong franchise. So I think that is where we reached from clearly being skewed in terms of dependence on the corporate franchise on the asset side. I think we reached a position where it's a lot more balanced, and that's what gives us the strength.
Okay. Well, let me get Saurabh's view on this. There is this big commercial corporate piece, which at the moment is giving everyone a little bit of worry. There is also another big challenge or disruptor for the entire banking space, the digital banking space. Are you reasonably confident that if you did a 10-year analysis of Axis over the next 10 years, you will still find it in your unusual billionaires? Will it be able to take both these challenges? Is there something in the bank that makes it nimble enough to face disruption?
So I think what I really tried to get out in the book was all of us in our day-to-day work in the market tend to get very focused and very obsessed about year-to-year challenges, and I think the degree of sort of angst and heartbreak in the market about Axis's loan book issues at the moment is an example of that. What you have here over 15 years is a bank consistently being able to position itself successfully in the market. Just to take an example which Srini was talking about, when the Enam transaction happened, I have to confess, amongst many other people in the city, I said, what are they doing here? This doesn't make any sense. But in retrospect, with gritted teeth, I have to say, Axis's ECM franchise, Equity Capital Markets franchise, clearly has been transformed by the Enam deal. And as Srini is saying, they managed to very nicely complement ECM and DCM in a way that I don't think anybody else in the country has quite pulled off. There might be other banks who are bigger, but I don't think anybody has pulled off this ECM, DCM piece. So sitting in 2012, I could have been one of those armchair critics saying what exactly is going on here. So looking ahead, Lata, crystal ball grazing is always hard, but my reckoning is that given what they've achieved in the last 15 years, given the core of the engine seems to be not just the MD. Consistently this bank has shown it's not just about the person at the top. The core of the engine seems to be fairly strong here, and given that the PSU banks do seem to be in terminal decline, I think the corporate opportunity facing this bank is very big. The corporate opportunity I think facing all banks, all lenders in our country is big, given the sort of structural decline facing PSU banks, and I'll be surprised. I will be surprised if, given where Axis stands in the world, they're not able to capitalize on that opportunity in the next 10 years.
Okay. Well, gentlemen, thank you very much. But I must say, Srini, the other examples in this book, or most other examples, Marico, Berger, Asian Paints, Page, Astral Poly, are all family-run businesses. And there the continuity of vision comes. In India, professionally run managements have not been able to really match up to family-run businesses, though it may sound, anachronistic to say that. Axis has managed that. I wish you every success. We hope that you will continue to be an exception to the rules.
Thank you.